So with that, we'll kind of get started with the SEC. I'm Michael Berg. I'm an insurance senior manager in the Nashville office. My colleague Amos will be assisting with this, and we'll, over the next 15 minutes, cover a lot of material. Really don't have an anticipation that we will get through all of it, but we will get through the primary focal points that we want to get through. We'll start off with the SEC update. We'll work into the PCAOB, and to the extent that we have time, we'll kind of talk about corporate governance. So on that note, a few things that we're going to cover, kind of jump right into this. Some things that are going on in the SEC right now. One topic is this disclosure effectiveness initiative. It's a very broad, it's basically the SEC, the commission is looking at all forms and disclosures and duplicate and trying to get that redundancy. It's all about the effectiveness of your annual reports and your filings for users of that information. One of the things that is interesting that they're actually looking at is the benefit of non-registrant financial information that are included in your filings. Whether it's from acquisitions, target financials for 3 to 5 filings, or if you've had the pleasure of guarantor, non-guarantor financial statement disclosures, which is a complete headache in my own viewpoint. The commission is looking at this, and does this really improve, or how can they improve the benefit of that? A couple updates to the financial reporting manual. There's been 2 this year. First one here, I believe we covered in our May update, but really relates to push-down accounting. The staff has historically had some guidance as to when to apply push-down accounting. The FASB has not until late 2014. They came out with some guidance. This update was really just the SEC aligning themselves with the FASB. And then finally here in August, the staff came out with a slight update relating to non-timely filers. The notion to pick up here is you can basically get current, get timely in your filings by filing a comprehensive 10-K. Any disclosures that you may have been missing, catch yourself up, you are timely. One thing to point out there, this is not to be confused with having a history of timely filings, and you can't file this current 10-K and all of a sudden I'm good and I can go on a short form S3 and with the SEC or something like that. So it's truly the notion of not becoming a delinquent filer. Consolidation, this ASU here, another fun topic on this really relates to VIE guidance on the FAS 167 and certain entities that have been deferred from that recognition. So money market funds really have been not under this guidance. They've been acting under this deferral of what was FIN 46R. And, I don't want to bore anyone or let anyone believe that I'm an expert on this topic, but basically this ASU gets rid of that deferral program. You are now under 167. However, there is some new guidance in there regarding exceptions. And so if you are in that money market fund or that entity, you may have VIEs there, something for you to consider. This is kind of a reference to a speech here on RevRec. The only thing I really want to talk about this is basically a speech where it's almost like companies aren't doing what the staff expects them to be doing for this new RevRec standard. We've all heard about it. It's been deferred another year. This is kind of trying to get companies moving on getting themselves ready and documenting and knowing what that impact on their revenue is going to be. I think if you were to go, I would recommend, especially to our public company, it may seem like it's 2018 before we have to realize it when you start thinking about the retroactiveness of this. So 2018, you may be presenting 3 years of financials. All of a sudden, you're talking about 2016, which is right around the corner here. So just, I guess, a word of advice, I guess, to make sure you are considering it or start considering it relatively soon. Cybersecurity, this is another thing that the commission, obviously with all the scandals going on, I know Greg talked about it a lot this morning, so I'm not going to speak too much. And he actually took one of my cool points that I had from it, and that was about the Target matter, that I thought was quite interesting. Really, the point of what the commission focused on is, one of the things that I've been reading about is small and mid-sized companies should be well aware. You see it in the news, it's the Fortune 500 types companies, because those are the ones that make the headlines. However, it's 3/4 of the hacks that are going out there are occurred by small, medium-sized companies. Because generally speaking, you have a less robust system in place. And on that notion, as Greg noted, was Target got hacked, if you will, because of a service provider. They basically had a small company, or relatively small companies, that were providing heating and air solutions to, I guess, their stores, and that was the weak point to where someone was able to hack into that system, unrelated to Target, but get access to Target through that third party. So kind of a broad spectrum. It's not only what is the risk of my firm, my company, but also my vendor relationships. Is there a way we can be impacted that way? Real quick on the Jobs Act, and then we'll switch to Dodd-Frank. This is really something the SEC has talked about. We talked about it in May, I know. Reg A, it's just another regulation out there to obtain equity. That, frankly, they've eased some of the rules because it's not being used. That's the skinny on the changes here on Reg A. One thing to point out on this Tier 2, where you can get up to $50 million in equity offerings, it doesn't get you out of financial reporting under the 34 Act. I kind of want to refer to it as 34 Act Light, if you will. You still have semi-annual reporting as opposed to quarterly reporting. You have current events still, just not on the 8K, it's on a different form. So it is a consideration, probably for reasons, probably still reasons why companies aren't utilizing this resource. At that, I'll have Amos go on.
Some of the adopted and proposed rules related to the rulemaking provisions of the Dodd-Frank Act. I think there are over 90 rules that are proposed or have been adopted to date under the Rulemaking Provisions Act of the Dodd-Frank Act. We're going to just go over 3 today. The first one that we'll look at is the pay ratio disclosure. This is actually a final rule. This was adopted in August by a 3-2 vote. This is going to become effective for registrants whose fiscal year ends or fiscal years begin on or after January 1st, 2017. As far as what this rule is going to require, it's going to require the issuers to disclose the median annual total compensation of all employees when you exclude the CEO, the annual total compensation of the CEO, and then a ratio of the two. This is going to be required in filings that require SK 402 disclosures. So that's really your annual report, your proxies, and registration statements. The other item of note here is just that certain filers are exempt, which includes your emerging growth companies, your smaller reporting companies, foreign private issuers, amongst a couple others. As far as the steps that a company is going to need to go through, you have the 3 steps up here. You have the 3 steps right here that companies are going to have to go through in order to comply with this rule. The one that I'm really going to focus on is just the first step there. This is going to really be the most time-intensive aspect of complying with this rule. It's the identification of the employee whose annual total compensation is the median of all employees when you exclude the CEO from the pool of employees. So this is the identification of an employee, not the identification of a dollar amount. So obviously going through that, it is going to take some time. Companies are going to need to analyze all their U.S. and non-U.S. Full-time, part-time, seasonal, temporary workers in order to identify that employee. Obviously, this could take a significant amount of time, so to help minimize the cost, the rule does allow for the identification of the employee to happen just once every 3 years, as long as there isn't a significant change in the makeup of your employee population. Now, obviously, you can just identify the employee once every 3 years, but you're going to obviously need to calculate their total compensation every single year. So what would happen, let's just say, if in year one you identify this employee and either this individual leaves or gets fired or gets a significant promotion that would significantly impact their total compensation. The rule has something that's defined as a similarly compensated employee that you would be able to use in years 2 and year 3 in complying with this rule. The next rule that we'll take a look at is the pay for performance provision. This is just a proposed rule at this point in time. The comment period ended in July, but nothing's been finalized as of today. This rule does not apply for emerging growth companies or for foreign private issuers. So basically, what this rule would require is, in addition to the total compensation that's already disclosed in your summary compensation table in the proxy, there's an additional tabular disclosure that this rule would require. So what it would do is, it would include both the total compensation from your summary compensation table, and then it would include your actual paid compensation for one, your CEO, then an average of your other named executive officers, as well as it would include your company's annual total shareholder return, and then the total shareholder return of your peer group. So it's really just comparing the compensation to what the total shareholder return is. That's really the purpose of this rule. The final rule that we'll look at here in relation to the Dodd-Frank Act relates to clawbacks. This again is just a proposed rule at this point in time. The comment period ended, I believe, in September of this year. As of now, there are no exceptions, so this can apply to everybody, including emerging growth companies and smaller reporting companies. This proposed rule is going to require that companies be able to recover compensation upon a material restatement from all current and former executives. This would include your president, your CFO, your CAO, really just any executive or officer that performs a policymaking function. This definition of an executive it's definitely broader than what it is in the Securities Exchange Act. So recovery is required under this rule, even if the executive officer was not engaged in misconduct, and even if they're not involved in the financial reporting process. Just one other final thing I want to point out in relation to this rule is that I've seen some companies adopt this rule kind of as a best practice. I mean, from their perspective, having something in there as a clawback provision in equity awards is never a bad thing. So some people have started adopting this before the rule has actually been finalized. The one thing I would caution and definitely recommend that you consider is just the verbiage that's being utilized in that provision. Some companies are being very, very ambiguous as to the clawback provision, and when you have extremely ambiguous wording in this provision, it's possible that someone would come in and conclude that there isn't an understanding of the key terms, there is no mutual understanding, and therefore you don't have a grant date, and therefore obviously that would impact your accounting for equity awards. Next, we're going to go through some SEC hot topics and some areas of focus in their comment letters. Here is just kind of a list of the different topics that we're going to cover here. Before we dive into some of these topics, we just want to provide a table here that highlights the top 10 areas of focus. This is based upon data from Audit Analytics through the trailing 12 months ending July 31st, 2015. As you can see, MD&A, as it was last year and has been for many years, it's the top area of focus with 28% of comments relating to MD&A. The first topic that we're going to go through is ICFR. So while ICFR was not one of the top 10 focus areas, there has been a noticeable uptick in comments related to ICFR. The staff has continued to issue comments to companies that have identified numerous control deficiencies but haven't concluded that there's a material weakness. They're asking, well, what considerations have you gone through in order to determine that these control deficiencies individually or in the aggregate don't rise to a level of a material weakness. Something else that the staff has continued to reiterate is the fact that the existence of a material weakness, it does not depend upon the actual magnitude of the error, or even if an error existed at all. It's based upon whether or not there is a reasonable possibility that a material misstatement could have occurred. So it's not what did happen, but it's what could have happened. And just a second bullet point here, obviously there are instances where companies are disclosing the fact they have material weakness. This is just something that the SEC staff often does request additional information, such as what is the nature and cause of the material weakness, who identified it, when, and what are some planned actions in relation to remediating that material weakness. Here we just have an example of an SEC comment letter, where as you can see just in those two last bullet points, they have focused on the ICFR impact of an audit adjustment. Next, we're going to be going through MD&A. So as that table depicted, obviously, just a couple slides ago, MD&A is a perennial hot topic. The SEC feels that MD&A should really tell a story, if you will, and it should be a discussion of the short-term and long-term analysis of the company through the eyes of management. And one of the ways that companies can help tell the story is to disclose and discuss some key performance indicators and some other qualitative factors that management uses when it comes to analyzing the company. So this would include such things as same-store sales, average subscribers, things like that. Additionally, the staff has noticed that MD&A often focuses on volume and product mix when it comes to companies explaining results of operations and trends year over year. And while the staff does obviously notice the benefit of discussing those items, they have recommended that companies include discussions of other factors such as pricing changes, acquisitions, new contracts, inflation, and foreign exchange rates when it comes to discussing the results of operations and changes year over year. Additionally, management should be discussing any material trends and uncertainties. For example, at the SEC Speaks in 2015 conference, the staff stressed that registrants with foreign operations in regions that are experiencing economic struggles, such as Greece, that they should be discussing in their MD&A any material trends or uncertainties in relation to the operations in those regions. And here again, we have another example of an SEC comment letter related to MD&A. While you read through that, the one thing I would like to point out is that this comment relates to a registrant's discussion of factors that affected their segments. The thing that I would like to call to your attention is that if you do have segments, it wouldn't be a bad idea to consider and discuss trends and uncertainties not only at the consolidated level, but at the segment level as well, and that's the kind of granularity and the type of information that the SEC views as being helpful to the investor.
Sure. The segments, the notion here, we had our media leadership conference a couple weeks ago now, and a couple of our panel speakers, which are members of our national office, were speaking on the importance of segments and kind of how the SEC has taken a new look at this. So maybe the SEC has looked at your segment conclusions in the past or questioned it. Just because they signed off on it maybe 2-3 years ago doesn't mean that they'll sign off on it today. I think there's a renewed focus in it. One of the things that was a theme of how they were talking about it is when you take a fresh look at your financial statements, read it from the standpoint of, for lack of a better term, am I being hypocritical? Am I saying we're a one segment or maybe a two segment company? But if you were to read my MD&A or read my business section of my financial statements, does it sound like you're talking about 4 segments or 3 segments, something that's basically invalidating your 1 segment or whatever your segment conclusion is? Those types of things are what the SEC is looking at. So knowing that there's importance there, that they are looking at that, maybe it's good to take a fresh look, clean up the documentation around segments, and kind of read through your financials to see, are we saying something different in MD&A outside of the financial statement?
Next, we're going to be talking about non-GAAP financial measures. So some of your common non-GAAP financial measures include EBITDA, adjusted revenues, free cash flow, funds from operations, etc. As far as regulations that govern non-GAAP measures, there are 2. First, you have Regulation G, which applies to press releases, investor presentations, and analyst presentations and conference calls. That regulation requires that the non-GAAP measure that is included in that presentation or discussed during that call, that it be reconciled with the most directly comparable GAAP measure. And then you have your Regulation SK Item 10E, and that applies to all your SEC filings. And it follows the requirements under Regulation G, as well as requires that management disclose how management uses the non-GAAP measure and why management believes that measure to be useful. So based upon some recent comments and recurring trends, there are some items that I do just want to point out to you in relation to non-GAAP measures. The first is that the staff focuses on consistency. So they're looking at the non-GAAP measures that you're disclosing on your website, or you're discussing on conference calls, or in analyst presentations, or in press releases, and they're going to compare that to the non-GAAP measure that you have in your SEC filing, and if there is some sort of discrepancy, they're going to issue a comment in relation to that perceived inconsistency and ask why it is that you believe that it's appropriate to discuss one non-GAAP measure over here and yet another non-GAAP measure over here. An additional item is that the staff does often comment when adjustments to non-GAAP measures are labeled as non-recurring, infrequent, or unusual. The regulation prohibits registrants from adjusting a non-GAAP financial measure to eliminate or smooth items if that charge or gain is reasonably likely to recur in the next 2 years, or that charge or gain occurred in the previous 2 years. Here we just have another example of an SEC comment letter. I'll just give you a couple seconds so please do that. On your conclusion about why you either do or do not, or how you've identified your segments. Some of the areas that they highlighted at that conference in relation to segments included the identification of the chief operating decision maker, the identification of operating segments, and the aggregation of operating segments. The final thing I just want to mention here is that when it does come to determining your segments, the SEC has stated that a company should be looking at more than just a CODM package. You should be looking at things like your budgets and your forecasts that are being prepared, how compensation is being determined, and just kind of overall your management structure. Here we have another example of an SEC comment letter. Next, we'll be going through revenue. So, while there is, with the obvious focus on revenue recognition does continue to be a focus area for the SEC. In the trailing 12 months ended July 31st, it was the number 3 top area that they focused on. Within this area, they continue to focus on such matters as whether collectibility is reasonably assured, your gross versus net considerations, multiple element arrangements, sales returns and sales discounts, things like that. Just to touch on a couple of these. First, in relation to collectibility, a company should consider all the items that are noted on the slide to ensure that the criterion is met in relation to collectibility and that revenue can be recognized when considering the other aspects of revenue recognition criteria. And then in relation to your principal versus agent considerations or your gross versus net considerations, the staff has stated that the analysis that it applies to identify the primary obligor focuses first on identifying the product or service that is desired by the customer, and then determining whether the company is responsible for providing that product or service. Again, here's another example of an SEC comment letter. Moving on to income taxes, at the 2014 AICPA conference, the staff stated that it doesn't really like how companies are just using boilerplate language when it comes to their disclosures in MD&A and in the footnotes in relation to tax. So they recommended some approaches that they consider to be more conducive to effective disclosure, and those included using your income tax rate reconciliation as a starting point and describing the details of material items within that reconciliation, as well as discussing significant foreign jurisdictions, your statutory rates, your effective rates, and the current and future impact of reconciling items. Additionally, there has been a lot of focus on the indefinite reinvestment of foreign earnings assertion, as well as the realizability of your deferred tax assets, specifically in relation to realizability of your DTAs. The staff has questioned whether or not those assets are realizable when a company has recognized consecutive annual losses or had a significant loss in the current year. Again, here's another example of an SEC comment letter that I'll just give you a couple of seconds to read through. Continues on the next slide here. The next area of focus relates to business combinations. So here we have 7 of the more common topics within business combinations that the SEC does focus on. Just to highlight a couple, the staff does frequently ask questions about how companies have assigned amounts to assets acquired and liabilities assumed. Additionally, they're going to often ask questions whenever there's a significant amount of goodwill that's been recognized to understand why companies haven't attributed value to identifiable intangible assets. Additionally, the staff often compares a discussion in your MD&A about business combinations and compares that to your footnote related to business combinations to identify any discrepancy. So if in MD&A you talk about the fact that you had acquired some customer, they're going to look at your footnote to check to see whether or not you've identified a customer relationship intangible or something similar to that. And if they don't see one, they're going to generally issue a comment in relation to that inconsistency. Another item that they'll ask questions about is in relation to whether or not companies have complied with 805-1050-3, and that just really relates to requiring certain disclosures when you have an individually immaterial business acquisition or business combination, but those acquisitions are material in the aggregate, where you still do need to disclose certain items in relation to those acquisitions if they're material in the aggregate. A couple other things in relation to business combinations. In addition to those items on the previous slide, there are some additional topics that we do continue to see the SEC staff focus on, and that's particularly in relation to pro forma financial information and the revenue and earnings figures since the acquisition date, and ensuring that those amounts are being disclosed, and if they're not disclosed, checking with the company, issuing a comment, and asking for them to provide those amounts so that they can determine whether or not that amount is material, and obviously ask the company why they chose not to disclose those amounts. Here we just have an example of an SEC comment letter, and with that, I'm going to turn it back over to Michael to go through the rest of the SEC topics.
All right. Well, much rather probably talk, I think, than the commission. On that note, we do have a big game going on. I'm a Ole Miss fan, but got to be rooting for Bama this week because I think that is good for my Ole Miss Rebels. If Bama wins, I think we're going to the Sugar Bowl. So, fun fact there. Going down to Goodwill, we have a few more areas that we're going to cover on the SEC hot topics, and then we'll transition to PCOB real quick before we run out of time. Watching the clock here so we know not to make sure we're running late at the end of the day. Goodwill, a couple things kind of cover long-lived assets as well, kind of in one piece here. Things that the commission has been asking our commonwealth you could expect to potentially receive is if you're testing impairment at interim date, was there an event describing that event that actually occurred that led to that triggering event, if you will? Companies are generally good at documenting, hey, we had an impairment, here was the amount. But what was the event? This may give some more context to a reader. What was the thing driving that? If you passed your step one test, hopefully. But, disclosing, did you pass it significantly to where, there's whatever significant would be defined as, disclosing that fact in your financial statements, as opposed to maybe you had 1% cushion on your step one test there, and was there different methodology describing that, giving a bigger picture and more clarity to the reader? Otherwise, hey, we do not have impairment, but boy, we pass by the skin of our teeth, That, not knowing that is a completely different concept to a reader. Now, obviously, you're walking a fine line on what you're willing to put into your financial statements, but the commission's always going to play that devil's advocate. One of the other things, going through the long-lived standpoint, and this is a key point, is the timing of when, and if you were to have an impairment, when are you going to record that? There are such things, and I think that's what this disclosure concept is trying to get at, is providing a reader, hey, we did have maybe back in our goodwill, we were close on, we passed, but, if things were to continue to trend down, maybe our projections won't be sufficient anymore, we have to revise them, so as opposed to that, you pass goodwill, or you pass your test in December at year end, and you recognize an impairment in the first quarter, make sure you have fully documented, considered the timing at that point. We actually have a couple comment letters in here for all these areas, and really want you to have this as reference points so you can take this with you and see if there's potential issues or thought process. We don't want to really spend too much time talking about them all. Fair value disclosures, once again, this is more on the effectiveness of those disclosures. Is what you're putting in your financial statements relevant, and is it provide benefit to the reader? Also, a lot of times you may have different valuation techniques, and actually describing those in your financial statements and what you're using, whether it could be a valuation of, typical valuation, you have three models, income, market, cost. A lot of companies aren't going to describe it, kind of going back to other outside just the fair value disclosures, level 1, 2, and 3, but are you describing, income approach, we recognized $1,000, and market approach was $1,500, but cost was $200. You probably weighted those, maybe you weighted them very heavy towards one of those things. Did you actually describe this in your financial statements, or did you just provide the fair value is X? But kind of walking through that to give a reader, there is this discrepancy. We're a real estate company, and it is income driven because the cost of really we don't think is relevant, and so we don't apply much basis in our presentation to that. Those types of qualitative disclosures, I think, is what we're looking for. Consolidation VIEs, I think disclosing more about your relationships. Do you have any VIEs? Going through that qualitative assessment of, all right, I have a variable interest. Or first you determine, I guess, do you have a variable interest? And then is the company a variable interest entity? Yes, no. It's thinly capitalized, so it's VIE. And then the next step is, all right, are we the primary beneficiary? The concept there is all about power, control. It's qualitative. What the staff is getting at is avoid any bright lines. And I know us, most likely all accountants in here, we want that bright line. It's easy. It's 75%, 90%, whatever. There's a general rule to avoid those types of bright lines. It is a qualitative aspect. Do you have control, power over an entity, and kind of going through and describing that thought process in your disclosures. Loss contingencies here, pretty relatively basic concept here, but what the key thing I want to point out is there have been some comment letters out there about describing what is reasonably possible. This is kind of a concept different from your FAS 5 contingent liability, what you recognize, which is probable and estimatable. So this is a lower threshold to provide the reader more of, you may estimate it, and it's probable that we'll have a $1,000 loss. Well, it's reasonably possible we could have $100,000. It's that concept, when you're talking about documentation, and it may not be likely, but it is reasonably possible. Concept there with that additional disclosure. That's kind of what this comment letter is getting at there. Cash flow is last thing here, I believe, on the SEC point. This is a renewed focus as well. It's kind of been the viewpoint of it's the leftover of the financial statement. It's the one financial statement that's derived from all the others. And I think there's just been an increased focus that the staff is looking at this to make sure that companies are putting the time and attention and the controls around cash flows to make sure that it is properly stated. At that, we'll kind of move in to the audit and PCAOB section here. We'll be kind of covering this pretty quickly. Really, the only thing here I want to talk about is there are certain instances where you could have a company that is not a registrant, but it has to be audited for whatever reason under PCAOB standards. There's a proposed ruling out there of what to do. Do I audit under PCAOB? Do I under US gas? There's this new standard here, and it also kind of changes the opinion out there. I know there's not many auditors in this room outside of BDO, but we'll wanted to let you know about that. Going concern, there's been some new guidance. The only thing I want to state here is this new ASU puts the burden, it's historically been an auditor's notion. This ASU puts management, a requirement on management to assess going concern from 12 months as of the date of the financial statements are ready or issued. So it's no longer balance sheet date, which is what the old audit standard was under. It's, if you're not issuing your financials till April 30th, it's 12 months from that date. So something to think about there. At that, we'll go right into PCAOB.
All right, the first aspect that we're going to touch on in relation to some current activities by the PCAOB is auditing standard 18. So when the PESI auditors come and ask you about related parties, if you work at a public company, just know this is a requirement. We're not doing it just to bug you. I'm sure that's what you think. So this auditing standard is effective for fiscal years beginning on or after December 15, 2014. So really this is the first year that most companies are going through this auditing standard. There are some significant new provisions which we'll go through in more detail here in the next couple of slides. So in relation to the risk assessment provision, it's really just auditors are going to be inquiring of management and others, including the audit committee, in relation to related parties. It's going to be talking with individual process owners and understanding what the entity's process is and their controls are in relation to identifying and accounting for related party transactions, as well as obviously when it comes to the identified related parties, inspecting documentation for the relationship and any transactions that occurred during the year. So if we do come across a related party that was not disclosed to us, we're going to perform the same procedures, i.e. looking at related support and testing the transaction, same as we would if the related party was disclosed to us. But if we do identify one that's previously undisclosed, we're going to do some additional things, as mentioned in the slide, which includes inquiring of management about possible other related parties, trying to understand why this one wasn't disclosed to us, assessing the need based upon what that related party is and the related party transaction, what other procedures we would need to perform. Additionally, the auditing standard does require the auditor to communicate to the audit committee the evaluation that we went through in relation to the company's identification of and accounting for and disclosing related party transactions, and additionally communicating other significant matters which are listed on the slide. Next, we have the PCAOB staff practice alert number 13. This was issued in September of 2014. Really, this is just reminding auditors that despite the fact that there were some recent accounting changes, the auditing steps that the auditors need to go through in relation to going concern has not changed. It's still for public companies being audited in accordance with Section 341. So this next area relates to a supplemental request that the PCAOB issued in, I believe it was June of this year. The comment period ended at the end of August of this year. So back in 2013, the PCAOB had proposed a rule that would require that the auditor's report include certain information, which would include the name of the audit engagement partner and certain other information about other participants of the audit engagement team within the actual audit report. This new re-proposed rule that was from June of this year just really requires that the audit firm would complete a form. That form would then be uploaded to PCAOB's website, and it would be there if you so chose to go and visit their website and look at that information, as well as gave auditors the option of including that information in the auditor's report. The next thing that was released by the PCAOB this year was the PCAOB staff inspection brief. This was released in October of 2015. This is actually the first time that they've released something like this, where it highlights the objectives, the focus, and the scope of the ongoing inspections of 2015 in the three general areas, as you do see on the slide, is obviously ICFR. That has continued to be a hot topic by the PCAOB. What the auditors are doing in relation to assessing and responding to risks of material misstatement, as well as the audit procedures performed in relation to auditing accounting estimates. Additionally, they also highlighted some other economic factors that they'll be taking into consideration when it comes to their inspection cycle, and that's just mergers and acquisitions and the other items that are listed on the slide. I'll just leave this slide up there for just a couple of minutes or a couple of seconds. This is just the PCAOB's plan for October 2015 to March of 2016. Then just a couple of things in relation to the Center for Audit Quality. They had released their third annual report this year. Really, all this does is just highlight for auditing firms some topics that they consider to be of import that inspectors might be interested in, including, again, ICFR, professional skepticism, cybersecurity, revenue recognition, related parties, things like that. And then the final thing in relation to the Center for Audit Quality, they did issue Alert 2014-3, and really what this does is just that it explains that cybersecurity risks across the company's entire IT platform, that those are not a part of the financial statement audit or the ICFR audit that your auditors are doing. It's just, obviously, the auditor is responsible for IT systems and data that is in scope, and that's just really just a subset of systems or data that is relevant to us, like your general ledger, things like that. And with that, I'll turn it over to Michael to take us over this session.
Okay, so last time here, so I'm going to just talk about kind of what the next slides are. There are some really good, if you are on an audit committee or just in general a person in charge of kind of governance of your entity, there's a few things I wanted to hit on, and it's really, there's several things that I guess, and there's a lot of publications within here, about audit quality indicators and what kinds of questions should you be asking your auditor to obtain an understanding, whether, for instance, understanding the PCAOB inspection process, whether or not if your engagement team has been through that process, or what's their firm doing in reference to that, if a company's planning on making a large merger or acquisition, how does that impact control testing, or how does that impact the planned audit procedures, or what do you have in place to be able to provide a high quality audit if the cards change all of a sudden on us. It's really, throughout here, there's a couple things. There's something on PCAOB, which leads on this next slide, the audit committee dialogue. This is a great little, about 9-page paper I think is referenced here, that I think it would give you some good questions of kind of relevant topics that are impacting many accounting firms right now, and things that you can kind of put your auditor on the spot a little bit, turn the table, And not that I'm putting myself out there for wanting a lot of questions like this, but these are the things that you can help identify a quality firm, quality engagement team at that to provide that high quality assurance. As kind of the importance of the audit committee, I think there's a speech in here that talks about the audit committee is a portion of a three-legged stool. So you have management, you have an auditor, you have the audit committee. The audit committee is an extension of the board of directors and that strategic governance. And it's really, those three parties are all responsible for delivering high-quality financial information. And a lot of materials that you can find in these slides, I just want you aware that can kind of educate you on what maybe expectations are from an industry standard or from a governance standard, and then also maybe some tools that could be beneficial in providing. At that, we're out of time. We're going to finish things